Hello, everyone. Stephen Mead here with Domicile real estate for people who love houses. And it is time for another one of our weekly market updates. This one is for June 29th, 2020. As I mentioned again, you might be saying it is June 30th and we are live. So why are we talking about June 29th? We always record our stats the day after because I need a complete day the day before. So this is sort of information as of 6/29. 2020, and I put in here in the title that prices are moving. I'm not going to spoil the surprise on it. We'll get to the details here in a second. But before we begin on these slides, I think sort of what's happening right now. And by the way, right now, I mean obviously there's some renewed coronavirus concerns. There's some other things going on, and this sort of underscores the reason why we're doing these updates on a weekly basis, because the reality is that our market changes on a weekly basis. Things change very quickly in our Southern California housing market right now. And before we begin, just a reminder, our stats are largely based on Los Angeles and Orange counties data combined together. We consider that a combined market. A lot of our clients move back and forth between Orange and LA County. A lot of them have jobs where they're able to live in both. So we kind of consider these markets sort of inextricably linked in some ways. And we also want to get our sample sizes up when we are doing such short time periods. So the shorter the time period you're analyzing, the broader your searches need to be, or you do not get a big enough sample size to have any meaning. I'm trying to remember what week we talked about this, but we actually went over sort of the folly of using a sample size that is too small and why the data can actually sort of lead you in the wrong direction. However, without further ado, we're going to start off with our slides, our stats that we normally report on. Let me pull that up here. And we can go ahead and get started. So I'm going to bring out the pointer here because a couple things are happening. This is our version of supply, and we call that new listings. So this is really just new listings that have come onto the market in the last week, right? So we pretty much we've kind of got our color codes here. These are chronological from left to right. We have an under 1 million category and then a $1 to $2 million category. And if we're looking at our number of new listings here, right, we see we kind of this peak level pre-stay at home, and we're kind of struggling to get back to that level of new listings. And while this week new listings have definitely gone up, we're still not trading at that same level. If we're looking down here at our 1 to 2 million, and again, just a reminder, this is Orange and Los Angeles counties. After 5/19, we actually were reporting $1 to $2 million. Before 5/19, we were 1 million plus. I think the 1 to 2 million is a lot more meaningful, but as you can see, we've actually slipped a little. We bounced a little last week, but the reality is I think we're seeing this story where it almost feels like we've kind of topped out on listings. And, what normally happens as we go into these summer months is this: we reach sort of this point at some point during the spring, in a typical market, a non-COVID-19 market, we reach a point in the spring where we're sort of supply constricted. Like there's just not enough houses. The buyers are fully in the market and the sellers haven't come yet. And then what happens is there's this delay, and sellers will see in their neighborhoods, they'll see some high price sales and they'll get really excited, and then a whole bunch of houses will hit the market. So I don't know if that's going to happen this year. This has not been a typical year in a lot of ways. So as I've said many times before, I can tell you exactly how the market is right now. And, anything else is we're just kind of throwing things out there as possibilities, right? So one possibility is we're supply constrained for the rest of the summer. The other possibility is that some sellers who've been sitting on the sidelines start to see these increasing prices, and then they want to jump into the market. And, next on our list here, I wanted to compare just how are we doing versus 2019? And I'm going to preface this by saying that 2019 by this time was actually not the best of markets really in terms of activity. And we are still in this under $1 million category. We are falling below probably by about 10% where we were on new listings. And this is starting to catch up a little bit, but I'm kind of really surprised at how long it's taking these listings to come up. And I'm going to pull off the share just for a second because there's a couple points that I want to make. if you are a seller on the sidelines, I mean, this is really the $1,000,000 question. Is this a condition that's going to exist for the next month, 2 months, maybe even 3? Or is this a situation where, this could end at any time? And I think if you're a seller, a lot of it depends on what you're planning on doing, right? What your strategy might be when the market stats look like this. If you are planning on buying another house, I'd say now is really a perfect time to be on the market, because you might be worried that the prices will continue to go up and you'll miss out on that, but it won't really matter, because if you're looking to buy something else, those prices will continue to go up too. So I think if you are looking to sell and buy, you really want to be in this position now where you put your house on the market, you know what you're going to get for it, and you can head out into the market with cash in your pocket. If you're a seller that, maybe you're somebody who isn't sure what you're going to do, well, then I think a lot depends on the type of property that you have. And one of the things that I think is interesting in a market like this, where we see we are very undersupplied, and I'm going to get into that in a second and show the numbers of why we continue to be, is if you have a property, homes that look like they belong in a magazine, they sell well regardless of the market. They are hot commodities. You could have 100 houses in your neighborhood for sale, but if yours is the one that looks like it was just in Sunset Magazine, people will want to buy it. Not necessarily at the price that you want, but you will have buyers for your property. If you have a property that is not one of these magazine properties, though, you really need to take advantage of markets like these, because this is the kind of market where buyers are going to be very forgiving of shortcomings. So for example, if you have a property type that has been harder to move, like a really large condo, or you back to railroad tracks, any of these kind of situations that make your property not a little bit of an oddball in a market sense, now is the time really to kind of take advantage of this kind of market. So that's kind of my 2 cents of advice for sellers this week, just looking at kind of how our supply graphs. I'm going to jump back in here, back into our slides, and we can talk about the demand side of the equation. And here we are with new escrows. And just as a refresher, I like to tell people this each and every time. This is really measuring the houses that went into escrow during the last week. So that means in the last week, these are ones where people, a buyer and a seller, negotiated a contract. So this is really the most current data that you are going to find. It is literally, it could be as recent as 1 day old, deals that were signed yesterday. And if we look here, it's a completely different story than on listings, right? I mean, we blew through the pre-COVID numbers 4 weeks ago, right? I mean, we've just been accelerating. And even in our $1 to $2 million range, same exact thing. I mean, we blew through those volume numbers a while ago. As you'll see in a second, we're still trending below where we were last year. But the fact that we've recovered well beyond the pre-COVID point is kind of an interesting one that I think shouldn't be missed here. Let's move on here. So, I mean, these graphs might look a little farther apart, but I mean, the reality is we're only down 5 or 6% versus where we were a year ago on these numbers. So, we still have a ways to go. And like I said, last year wasn't a particularly great year volume-wise. I might actually add a 2018 chart in here for next week, so we can kind of look and see, kind of looking over the past 2 years where we are volume-wise. But, as you can see, if this is our demand side of things, demand is recovering faster than supply. And how we reconcile these numbers is with our absorption rate. And, I think this really tells the story of the market. I mean, we see that, absorption rate was pretty lousy for these luxury properties. And then, boom, it started going back up. And I mean, now we have a very, very healthy rate. Anything over 80% is totally a seller's market. And anything over 90% means that, and I think I mentioned this last week, we're trending around 93%, 93.5, 94% on our under $1 million category. And you might be thinking, well, we can still go to 100%. Well, actually, 100% doesn't mean what we think it means. And let me go off share here. So our absorption rate is a simple calculation. It is the rate of new escrows to new listings. And you might think, well, what we want to aim for is 100, right? Every new listing that comes in the market, there's a buyer for that many houses. But the reality is, anything over 90% is actually really over 100%. And it's kind of like unemployment numbers, right? Like you can never actually get to 0% unemployment. And it's kind of the same thing with these absorption rates, because 10% of the houses that go on the market on average never find a buyer, meaning the sellers weren't really that serious. They changed their mind. There's a lot of reasons why these new listings might not turn into a sale, but on average, it's about 10% of them in our market. That fluctuates a little bit, but we'll use 10% as our number. So that means if we're over 90% absorption, it means we're actually eating into the properties that are already for sale. We are buying up properties faster than they are coming onto the market. And that's sort of my definition. I call that a hyper competitive market or a hyper sellers market. It means the balance of supply and demand is very much in the favor of the sellers. And it continues to be, if we go back here and take a look for a second, it looks like this might be flattening out. Like we kind of had, let me grab my pointer here. It looks like we had a bit of a jump up and then sort of this curve is flattening. I don't know if we really have enough trend. We see the same thing over here in our $1 to $2 million range. So, obviously there is a bit of a ceiling, you can only go so high before you actually run out of properties to sell. And I wonder if that might even already be affecting sort of our pending numbers. They might actually be even higher than they would be last year, but we just don't have enough inventory, right? This is like going to the car lot to buy a car and they tell you, well, we only have 5 cars left. That doesn't mean they have no cars to sell, but if you don't like any of those 5, you might not buy a car. You're going to hold off until they have more inventory. And I think we might very much be seeing that effect in our market here. And really, this is the big slide, right? This is the one that we've been sort of waiting for. And before I go over these numbers, I want to talk about something last week. So last week, we actually saw our average pending price fall. And I think that was sort of an unexpected number to come out, right? No indications in the actual marketplace were saying that prices were falling. And I said, well, maybe there's something else that explains this. Maybe there's this lag where people are bidding over list price. And if you remember, if we go back to this chart here, something I always tell people, I love the recent data by using pending list price, but this is the list price that the property was when it went into escrow. It is not necessarily the contract price that was negotiated. So that means if everybody starts bidding over list price, prices are going up, but this number wouldn't reflect it. If we were to kind of draw a trend line, and I'm going to get out my spotlight here, you'll actually notice that we do have this blip. Every once in a while, we have these blips that show up. And if we draw this trend line, we are now right in line. But I think what's fascinating to look at is between last week and this week, we jumped nearly 3% in our under 1 million category in prices. I mean, really a very large 1 week jump. But if we look back to 2 weeks ago, we've really only gone up about a percentage point or half a percentage point a week, which, that is a really big rate. But for us in the spring, that's not necessarily that unusual. And if you look at this number here and you look back where we started, right, pre-stay at home, this average pending list price was $612. Now we are at like a $634. That is nearly a 4% jump in prices, over the last few months. I'm gonna stop the screen share because I want to do something with my hands that I think will demonstrate what I'm talking about. In life, sort of, if you ask consumers how they think prices work, especially in a market like Southern California that doesn't have kind of the weather seasonality that a lot of other markets in the country have, people expect that home prices do this. They start low and they just sort of rise gently like this throughout the year. Well, guess what? It doesn't work like that. And it's really never worked like that in our market. Historically in Southern California, we tend to reach this point in the spring where we get inventory constricted and prices over the period of like 30 days tend to take a big jump. And then that rate of acceleration is lower. And then when we get towards the end of the year, they actually start to kind of fall off and the market gets a little bit soft, right? And That seems to be the way it happens almost every year, not every single year, but we kind of have these price jumps that happen in these sort of fits and starts where there's these periods of time of hyper competitive environment and they jump a bit. And I think it's really important to remember that. So when we go back to this graph and we make a statement like in the last 3 months or so, 3.5 months, we've seen a 4% price increase. That does not mean that 2020 will be a 12, 13% year for price appreciation. It's not impossible, but that's sort of expecting these trends to go through the whole year. And historically, we've kind of seen that tends to not be the way that it is. With that said, I do think our prices have some room to keep growing and still be within historic affordability. So if we move on to the next chart, which is our list to close ratio, right? And I talked about this last week. This is the ratio of list price versus closed sale price, right? So, if a house was $1 million and it closed at 900, that would be a 90% list to close ratio, right? And if we look at these numbers, right, we've kind of studied these, and these are the ones that closed in the past week. And we see that number is going up slowly over time. We're actually almost exactly the same number this week as we were last week, 99.5%, I think it is. But then I kind of introduced this new category, right? This is called last week's escrow. So this is looking at the properties that not only went into escrow in the last week, but also closed in the last week. So these are like the freshest possible sales. There were only about 50 of them. And, for the second week in a row, that is over 100%. That means that on average, people were bidding over list price for those houses. And I think that's a very telling indicator of what we can expect. And as this number catches up, because remember, if a property closed on 6/23, on average, that means the sale was negotiated back here in May. It wasn't negotiated in June. I think as we progress, we're going to see this number go towards this 100% amount. We're going to see it change sort of week to week. This is kind of our story here for our 1 million plus or our 1 to 2 million after 519. That's why we see this change here. And, we've seen really the same thing. These price changes aren't quite as dramatic, but we did have a rise this week over last week. I think it was about 0.5% as well. So we're kind of seeing the same story at both ends of the market. And I think whenever you see both ends of your market moving in the same direction, I mean, that really sort of adds fuel to the narrative, right, that you're seeing. It adds a lot of confidence in what you're seeing. Finally, if we move on to our days on market for new escrows, again, we saw a little bit of a jump here in our 1 to 2 million. That seems to happen in this market periodically. We don't have as many sales. This could be a statistical anomaly, or we could have actually had one house that had been on the market for a really long time. It isn't terribly uncommon in these upper price ranges to see listings that might last for a year. But if we look in our under 1 million, I mean, we're right back here at like 32 days on market as our average. I mean, realistically, folks, that is incredibly fast, because that means for every house that took more than 32 days, there was probably one that took a bit less. So, I mean, we're just in a market that is moving very, very quickly. If you are a buyer in this market, I'm gonna cut away here for a second. I gave some advice for sellers, and I'm gonna give some advice for buyers. A couple of things to understand when you're in a rising market if you are a buyer. I know number one to consider is this. Waiting can be a very risky maneuver. And I'm not talking about waiting for the right house, because I think that's a whole different conversation. I mean, just waiting on the basis of time, right? Because every week that you are wrong is a week that costs you money. And while we talk about, these price movements being 0.5%, 1% week over week, 4% since we've started, the fact is, if you are buying a house, these numbers are real money. So the difference between pre-stay-at-home and now, that is a $24,000 difference on an entry-level single-family home, right? That is approximately $50 a month. Or actually, no, $24,000 is actually it's a little over $100 a month difference in payment, right? Has happened. And that's even with rates staying exactly the same. So when you think about waiting, understand that there's really a cost to that. The other thing too that I tell people to consider, and this is the reason why prices jump, and the reason why prices jump is because if your goal is to get a good deal on a house, and I think that's most buyers, right? Most buyers want to get a good deal on a house. Understanding that, you know, today's bad deal on a house, where you overpaid by $4,000, could be next week's great deal on a house because of how much prices have moved. So I think sometimes people get caught up on the emotions. I tell people, if there's a house that you are in love with, 10 years from now, you will not care whether you paid $5,000 more for it. I promise. It will not make very much of a difference to you and your happiness. But emotionally at the time, right? I mean, we fight hard. This is hard-earned money, and we fight hard for it. I'm going to move to our last slide now, and this is the one that I started including, our affordability slide. And you know, if we track, right, I'm going to get my pointer out here. If we're tracking over the last 2 years, so if we started back here June of 2018 and we use that as our baseline, you know, look where we are. We are pretty much, we have barely moved. I think we moved 1/10 of a percentage point. We're trending right around 90%, between 90 and 91%. And, you know, again, with this market, this graph tells me a couple things. So just as a reminder of how we calculate this, this is Orange County homes, single family and condos. What we do is we look at the median home price, we look at the prevailing 30-year fixed rate mortgage as given by Freddie Mac, and we come up with an 80% loan to value or a 20% down payment based on those two facts. So what's cool about this figure is that this number moves based both on the price of the house and prevailing interest rates. So when you look at this kind of factor and say, well, we're still 10% below where we were 2 years ago in terms of payment, understand that changing interest rates could also be the thing that changes this. I'm not really seeing a large appetite for interest rates to change prior to the election, but you know, smarter men than me have been proven wrong about that. So just understand again that this is the way things are, and note that a change in both median price, which is what a lot of people are watching, as well as interest rate, could sort of move this number towards this 100%. The other thing that I want to mention here that was pointed out to me by a viewer, and this was a great question. I didn't put this in here because I wanted to make this graph really simple, but the fact is, you know, we've had inflation in the last 2 years, and we've had wage growth, right? So the reality is that we kind of have another 6% built into this, right? Just on inflation alone, another 5 or 6%. So the reality is, from a pricing standpoint, people feel like we're running out of room. We're not. Prices could, you know, prices could jump. If interest rates stay the same through the summer, you know, prices could move 10%. I don't think that's not impossible for that to happen. So just understand that a lot of our price discussion we're having right now, where everyone wants to talk about this idea of pent up demand, right? That's what we're seeing, that sort of all these buyers coming out of the woodwork. You know, I think the explanation is probably a little simpler than that. It's not uncommon in our market for buyers to move faster than sellers in the springtime. We're a little late for it this year, but that's understandable given COVID-19. I think, you know, I have a feeling that future prices are not really going to be driven by demand. I think they're going to be driven by supply. So if everyone decides in the next 30 days that they want to put their house on the market and move, that will have a negative effect on prices. I think that's really where the big discussion in at least the next 30 days is going to be. I think the heightened springtime demand, this doesn't seem that unusual, out of the ordinary for me. I don't know if I'm ready to call that pent-up demand yet. It really hasn't let out. Pendings went up again. They're holding steady. We're almost at last year's numbers. So it's not like we're at these huge, wild, you know, numbers on demand yet. So that's kind of just my take. We'll have to see where we are next week. And as always, if you have questions, comments, if there's anything we can help you with to help you make better real estate decisions, that is what we are here for. Yeah, reach out to us, and we will see you next week.